And welcome, it's Mary Ellen McGonagle with your Friday afternoon weekly Edge show for Friday, April 5th. Today, as usual, we're going to take a look at those broader markets. We had a little bit of a dicey period Thursday into Friday. We're going to see where we closed for the week and then beyond. Some of these sectors are not returning back into uptrends. You'll want to know about that, as well as sub-industry groupings that are on the move lower as well. Some of the headline news that drove price action, we're going to take a look there, and then key data due next week as well. And then last up, viewer question of the week, and it's all about using historical precedents relative to that price action yesterday to potentially get a guide as far as what we may see going forward. So first up on that data last week, we did see strong numbers coming in relative to the economy at the beginning of the week. This manufacturing gauge did turn positive for the first time in 17 months. We saw factory orders come in, the strongest in 8 months. And beyond that, certainly Thursday into Friday, we had many Federal Reserve officials that were speaking, and their comments pushed the markets lower as investors feared that we may not see certainly as many rate cuts or a rate cut program from the Federal Reserve occurring as soon as we had anticipated. Now, today on Friday, we did get some key employment data for March, and it came in much stronger than expected, and the markets were able to shrug that off. Some of the reason there was a silver lining where wage increases were only modest, but it was certainly an interesting difference from Thursday. Next week, we do have core CPI and PPI data, both important inflation numbers that may move the markets next week. So you'll want to be on the lookout for that. So let's go ahead. Where did we close for the week? And here we are with a daily price chart of the S&P 500. And here we are with yesterday's sell-off, where we closed below that 21-day simple moving average. That RSI got into negative territory. However, we were able to recover. Today's 1% rally put the RSI back into positive territory, and the S&P is now back above that 21-day simple moving average. The MACD remains in positive territory, so with the near-term uptrend in the S&P 500 remains in place. From here, let's take a look at the underlying sector in the S&P, and these 11 sectors are sorted in relative strength. It's not a whippy view. These sectors do move their position from these stronger areas to weaker rather slowly. But let's take a look up at the forefront. Energy up almost 4% this week. This sector has been on the move higher. And then I'll share with you in the next segment a view of the price of oil, which is really quite elevated, and that's certainly helping to propel these stocks higher in the midst of conflict in the Middle East. Up here also at the forefront, industrials, they pulled back with the market last week but recovered quite nicely. That RSI momentum indicator never dipped into positive territory, and the uptrend in that sector remains in place. Certainly different view here is technology. We did close yesterday below that key 50-day simple moving average. We were able to barely close above it today, but we do still have that RSI in negative territory with that MACD still heading down. So not much strength in that overall technology sector. Another area that got hit hard this past week, and I'll share with you where that weakness was, this is healthcare. We have very decisively closed below this key 50-day simple moving average, high volume selling indicating distribution, and that MACD now in negative territory. RSI also negative as well, so not looking particularly healthy for that healthcare sector. One other area I did want to point out to you that has been in a declining phase, and it comprises a pretty good part of the S&P 500, and that is consumer discretionary. You can see XLY has in fact closed below that 50-day simple moving average, negative RSI, and a negative MACD. So another sector that is exhibiting weakness and also is in a downtrend. From here, let's go ahead and take a look at some of these sectors and the industry groups in them. Again, 2-month daily price chart view, and up here at the forefront is Brent crude oil, up here at $90 per barrel, very elevated, and we can see that that certainly is one of the drivers for energy stocks continuing to advance. Also up here at the forefront, not what we want to see, but this is the yield on that 10-year treasury up here at about 4.4%. So we can see interest rates are up certainly above that 4% level, but the broader markets, we are seeing that weakness in those growth areas in response. Now, as we move through, I wanted to share with you other areas such as the home builders group, and it did pull back going into yesterday's broader market pullback, and it's all about the rise in interest rates is increasing mortgage rates. So despite the weakness, the momentum is still in positive territory. So home building group overall remains constructive. I talked about healthcare pulling back. Let's take a look at one of the industry groups that's a big component, and that is the medical devices, IHI ETF, also closing just below that 50-day simple moving average. And we can see that the MACD is now poised to enter into negative territory. Another area in healthcare is biotech, the weakest of these underlying industry groups. And you can see it has closed well below that 50-day with that MACD now in negative territory as well as the RSI. And this certainly signals a risk-off environment when biotechs are selling off. One last industry group that I did want to review with you is banking, and they did enter into an uptrend, but it's losing that uptrend. We can see that the RSI now in negative territory, and likewise with that MACD. And so this is another area, if you are overweighted, you'll want to reconsider your positions. From here, I also wanted to share with you a view of the VIX or Volatility Index, and you can see for the week that it is higher. This is that spike on yesterday's sharp pullback in the markets, and we are here at that 16 level. So if we continue to advance, certainly any level closer to that 18 will be potentially ominous for the broader markets. Now from here, I talked about viewer question of the week, and it's all about the S&P 500, the broader market price action. So I'm going to share with you an intraday chart that will allow a closer look at what took place yesterday on Thursday into the close. The markets started the day on a bullish note, and you can see that we were poised to end in positive territory, but this one lengthy red bar is the last 2 hours of Thursday, and the markets pulled back 1.7%, a very hefty decline. It also took place on very heavy volume. And when looking at this sharp pullback, on the lookout for historical precedent, and we'd have to go back to December 20th. On that day, you can see this is the bar of the last 2 hours on that given day, and the markets pulled back 1.5% after entering and going into what thought would be a bullish close. We did see that sharp pullback. Now let's take a look at what took place subsequent to this December 20th pullback, because there were other similarities more than just a pullback in the last 2 hours of a bullish looking day. And that was on the 20th, similar backdrop where investors had been quite bullish on the fact that the Fed would execute interest rate cuts at a sooner point than formerly thought. And when it came to light with Federal Reserve official comments that that may not be the case, the markets pulled back sharply. That's exactly what took place on Thursday. So if we take a look at this 2 hour intraday view of the S&P 500, you'll see that the markets did rally a bit, but we still had the momentum indicators heading south, and that's going to be this MACD. We also had the RSI generally trading sideways and then downward. It was not until January 8th that the markets regained their uptrend. It was signaled by this MACD crossover on this 2-hour chart, and then a move above these moving averages with that RSI in positive territory. So if we take a look at this 2-hour chart and what took place yesterday, we do still have that MACD heading south, and also that RSI is not in positive territory quite yet. For those of you that would like to have a closer examination and be alerted to a more bullish period in the markets than where we are currently, use that link below and you can trial my twice weekly MEM Edge report. I put out a Thursday alert report yesterday due to that price action. You'll have immediate access to that as well as upcoming reports. Have a great weekend. I'll see you again here next Friday.